Welcome to this podcast of Real Estate Prosperity. My name is Robert Metz. I'm the author of the just published book entitled Real Estate Prosperity. My book is available in both e-form and hard copy at www.realestateprosperityllc.com. In this series of podcasts, and this is number 6 in a particular series, we're discussing the 28 primary methods of financing or controlling your deal, whether you're buying a property in foreclosure or virtually any other type of property, generic, multiple listed, bank owned, etc. 28 essential methods of financing or controlling the deal. And again, I say controlling because sometimes you get into a deal and you do not take title right away, but you need financing, you need resources to control it, to get a legal foothold and get a proprietary interest in the property to enable you to do things with that property. Rent, resell, flip, renovate, etc. Briefly, I'd like to mention what's sometimes referred to as a third-party partnership financing. Basically, a variation of the equity participation type deals where business people, investors are looking to park some money, get in on deals, get a percentage. Not traditional lenders, not licensed lenders, but money people, companies, speculators, real estate holding companies who have some money and they're looking to get into a deal. Third-party partnership financing is basically a third party, an individual or company that wants to come in on the deal, get a piece of it, get a percentage of it, and finance the deal without you, the primary buyer, having to go to the bank or seek a mortgage, which you may not be able to get given the property or given your own situation. Another way of financing or controlling a property is by taking the property you want to buy, and putting it in the name of a spouse or other third party. Obviously, and I touch on this in a bit of detail in my book, there's certain issues and risks, family and otherwise, trust issues, financial, tax issues, which should be delineated in most cases in a small agreement between the party whose name you're putting the property into and your name. But there are ways to make a deal to control the property when the deal could not otherwise be made by putting it in the name of a spouse or other family member or third party. Again, there can be a cost for the deal. One would assume that in a spousal situation, there's not a cost, but bringing in a third party, even a family member, they might want a percentage of the deal. They might want X or Y. But again, depending on the transaction, depending on the numbers, putting the property in the name of another party and having a two-way agreement between you and that party may enable you to get control of a property and maximize its potential, flip it, renovate, rent it, whatever, whereas otherwise on your own, you could not do it. Now, putting the name of the property in the name of a third party is a means to use somebody else's better or sufficient credit in order to qualify for financing, or to insulate the property and the financing from yourself, from your name, if you have credit problems, tax liens, judgments, marital issues, other risky business issues that could impact your ownership of the property. So putting the deal in the name of a third party, having an agreement with that third party, getting your financing this way, can be a very valuable means to control a deal, to do a deal, to own the property, whereas otherwise it would be impossible to even entertain the proposition. Many times, you might need a cosigner on the note. They say somebody to co-sign on the paper, just as if it were an auto loan. Your credit, your income may not be sufficient to do the deal. Again, a cosigner may come with a cost or not, depending on whether it's a family, spouse, friend, business associate, stranger, who you meet through business, you name it. Having a cosigner on the note can help make a deal, obviously, whereas otherwise on your own 2 feet, you could not do it. And depending on the cost of the money, again, it's not a loan, but depending on the cost of the participation, we might say, it can be a very cheap and efficient way to do a deal and make a deal happen. Obviously, and again, I detail this in my book, there's certain risks, credit and otherwise, for both parties, most of which can be guarded against by way of a supplementary agreement between yourself and your cosigner. Sometimes there could be complications, but so be it, and that is the nature of any business transaction. In certain situations, the bank will not want a cosigner. In certain situations, your credit may be so poor that the good credit of the cosigner will not matter anyway. If your credit and your financial position is terrible, the bank may say, hey, we don't want a cosigner. We'll sell it to him. We'll put it in his name or her name, but we don't want you on it. Your credit is too poor. So a third party co-signing on your note is not a magical cure-all for every poor credit situation, but in many situations, many marginal situations, cases where you need to insulate a property from other liens and risks, having a co-signer is an excellent opportunity to do a deal where otherwise a deal would not happen. Now, one arena which is a tremendous arena, and the crux of most of my book, is buying property to flip. Buying what they used to call, and some people still do, as a PUC, purchaser under contract. You enter into a contract and you have not yet closed. You can maneuver, you can deal in foreclosures, you can deal in other depressed properties, you can flip the property, you can do a variety of things as purchaser under contract. This is sometimes called the deposit money method of flipping. Again, you need a smartly worded contract and you need a good deal. You can flip the contract or you can flip the property. It all depends on the terms in your contract. I've bought more than one property over the years where I never took title. I never even sought to obtain financing. I knew what my deal is worth. I knew what the market was. I assigned the contract to a third party, got a percentage, or got a certain set sum, either for assigning him the contract, letting that other third party step into my shoes as a new buyer, or letting him step into my shoes as a new buyer and giving me a certain piece of the action, so to speak, or percentage upon his closing or his resale of the property, or both. So buying as a PUC allows somebody with sometimes credit issues, oftentimes a lack of resources, a lack of cash, to buy a property. Buy and control can oftentimes mean the same thing. Sometimes it could be more valuable to control the property, to get what we call a proprietary interest, to get your foot in the door, to get a toehold, to get control over the property without, quote unquote, formally and finally buying it and taking title with new financing or with all of your own money. The control is the key, that you can flip it, that you can sell the contract, you can close on it, you can bring a partner in either before closing or after. Control is a key. And a lot of that goes to the language in a contract. When you're buying a property, you do not want a contract that says it's not assignable. Ideally, you the buyer, you the flipper, you the speculator would like a property contract, purchase contract, to say, quite simply, it is assignable, period. No terms or conditions, no consent from your seller, no nothing. You can give the contract to somebody else and make your third-party deal. You can flip the contract. Or you would like a contract that says you can assign it with your seller's consent, but his consent may not be withheld unreasonably. So either way, with or without a clause requiring consent or a form of consent, which cannot be withheld unreasonably from your seller, having an assignable purchase contract on a piece of property that may be in foreclosure or may for other reasons, financially or physically or both, be a terrific buy. Having an assignable contract gives you great leverage and power to do something with this property on day one, long before the stipulated closing date in your contract. Flip the contract or flip the property. Control the property only with your deposit money. Have a cleverly worded contract that gives you flexibility to deal with the paper, to deal with the property, to do something with it, to make a profit right away, to not have to close, or to be able to close if you want, to not have to maintain the property, or to maintain it if you want. But a smartly worded purchase contract that's assignable, ideally with no consent, or with marginally compromised consent conditions, is a very valuable tool and a very, very valuable contract. Sometimes the purchase contracts can almost turn the deal into an option. Not literally an option where you have a black and white piece of paper that says you can buy such and such on certain terms, but by being so liberal in the assignability of the contract that you basically have flexibility to deal with it. You got an option on the property, or you got a purchase agreement, whatever you want to call it. You have a valuable agreement that you can flip, that you could sell, that you can assign as purchaser under contract. And your job, once you can locate properties and execute the contracts, control them with a deposit, is to find your own investors, your own third-party investors, and end users and buyers to sell it to. I've dealt in more than one property, sometimes very modest one-family houses, even going back years ago, where with small numbers, percentage-wise, a good profit, a nice, clean, easy deal, where I sold my contract to a third-party buyer who was going to occupy that property, and himself might have gotten a VA or an FHA mortgage, for example, and we'd have a closing where I went there as a middleman. My seller was there. My buyer was there. My buyer funded the purchase through his new mortgage. That funded the amount that I had to pay to my seller after the deposit that I had tendered on day one. And that also gave me the profit, my profit, and paid all the transaction costs. I've been involved in these transactions, and again, all quite legal and proper, where there are 4 and up to 5 parties involved on certain properties, where I might have been party number 2 or 3, and I might have assigned or sold it to somebody else who might have still assigned or sold a contract to still somebody else. Again, it depends on the margins, how much money is in a deal, how much work is going to be required, if anything, what kind of approvals might have to be obtained from the municipality, who wants to bear the exposure, who wants to make a quick profit, get rid of the deal, put no real work into it, put up a marginal small amount of money, get a nice profit, and let somebody else do the work. Let somebody else close on it and finance it. And again, flipping, buying as seller, as PUC, as purchaser under contract, provides opportunities when you're underfinanced to basically finance and control the property as PUC, as purchaser under contract.